Today I'm going to break down corporation tax into everything you need to know: how much it is, when you need to pay it, who needs to pay it, and how do you pay it. Corporation tax is often surrounded by confusion. There's a ton of things you can do to reduce your tax bill that you may not be aware of that I'm going to talk through today. This video is for new business owners, but also for established business owners that have just been paying their tax bill as they go without fully understanding why. Let's start with what is corporation tax. Essentially, it's a tax on company profits. That means you do not pay corporation tax personally, you only pay it through a limited company. Now that's a broad definition, but corporation tax can also apply to branches of foreign companies that operate within the UK and some unincorporated associations such as clubs and cooperatives in some situations. Next, let's look at what gets taxed. Corporation tax doesn't stop at your trading company's profits. It can also apply to investments. For example, if you have a company that holds a property and you sell that property for a gain, that gain would be subject to corporation tax. If your company has a lot of cash in it and you're earning interest on that cash, you would be subject to pay corporation tax on the interest. So it doesn't just apply to profits, it's also a tax on gains and a tax on other income. Key thing to keep in mind with corporation tax is that it's a tax on profits and not on revenue. That means if you don't make profit, you don't pay corporation tax. It's because of this that you can do some smart, strategic, legal tax planning to help reduce your corporation tax liability fairly simply. Now let's look at what corporation tax rates are in the UK. Currently, corporation tax in the UK is 25%. However, if you're a company that earns less than £250,000, you also qualify for marginal relief, which reduces that rate from 25% tapered all the way down to 19%. So if you make a profit of £50,000 or less, you'll be taxed at 19%, £250,000 or more, 25%. And if your profits are in between, you'll be taxed somewhere between 19 and 25%. Now, what a lot of people think at this point is, well, why don't I set up multiple companies and not let any of them make more than £50,000 profit? HMRC has got you. There's something called the Associated Companies Rule. This rule is designed specifically to stop people from artificially decreasing their profitability. Now that we know who pays corporation tax and what rate it's paid at, let's look at what it's paid on. This is called your taxable profit. At its most simple level, you take the revenue your company made, all of the tax allowable expenses that were made, and that will give you your taxable profit. Now, there is a bit more complexity to it that I'll run through, but that's a basic concept you must understand. Now, when I say tax deductible expenses, what I'm talking about is stuff that HMRC will allow you to spend through your company. The key thing here is it only includes expenses that are wholly and exclusively for the purposes of the business. Stuff like client entertainment is typically a disallowable expense, meaning that you can't take it off your revenue when calculating your taxable profit. So what are typical expenses that you can put through as tax deductible? Well, for most of our clients, the biggest cost tends to be people. That's payroll staff, freelancers, and anyone else that's working for you. Associated with team are other costs that are required to have that team in place and operational. This can include the essentials like NI and pensions, but it also includes things like recruitment fees, training costs, development, equipment, and everything else that's required for that individual to perform their duties. Another one is premises costs. If you have an office and you're paying rent and bills and business rates, these are all allowable expenses. And anything else required to deliver your business's services. Now, when you get your taxable profit, you'll know where you sit within the range we previously spoke about, where the margin of relief applies, and therefore what rate of tax you're due to pay. You can then simply times your taxable profit by that rate to tell you how much corporation tax you need to pay. Now that we've covered the foundations, you can probably see that if you can maximize your tax deductible expenses, you can lower your taxable profits and therefore lower your tax bill, both in terms of the rate that you pay and the amount that you pay that rate on. But beyond just spending money to reduce your profit, there's more you can do to significantly reduce the amount of corporation tax you pay. Let's talk about capital allowances and other special deductions. Capital allowances are particularly important to understand. When you buy assets for your company, they don't just go through your profit and loss as an expense and reduce your taxable profit. They sit on the balance sheet and they're depreciated over time, meaning you take the cost of that item over a number of years. Capital allowances are the tax equivalent of depreciation. And for some asset purchases, you can apply capital allowances that give you a 100% deduction in year one, rather than spreading that out over a number of years. A great example of this is electric cars. They have a special capital allowance associated with them that allows you to take 100% of the cost of that car through your company in year one. That means if you made £100,000 of profit and you spend £100,000 on an electric car, you can take the full cost of that car off your profits, so essentially zero, and pay no tax. If instead of an electric car you decided to buy a Lamborghini Urus through your company, you would only be able to take 6% of the value of the car off your profits each year. So you've had a big cash outflow with very limited tax savings as a result. That's why choosing the right assets to purchase through your company is so important, so you can maximize the capital allowances and reduce your taxable profits. Alongside capital allowances and asset purchases, research and development tax credits are a massive needle mover, especially for agencies and other software-driven businesses. You've invested time and money into building something that hasn't been done before, that is experimental, that really pushes the boundaries of the industry, and you can demonstrate that, you can have massive tax relief through R&D credits. An R&D credit can result in cash back in your bank well over and above what you've already spent. R&D tax credits work very differently to what we've discussed so far. So far, we've discussed how you can reduce your taxable profits ultimately through maximizing your expenditure and taking advantage of capital allowances. A tax credit, however, is an amount back to you. It doesn't come off your profit, it's a full amount that you can receive as cash into your bank. And finally, let's talk about tax filings and tax payments so you don't miss a deadline and get fined. Now, unlike personal taxes that run a standard tax year ending the 5th of April, corporation tax is specific to your company, so there's no single deadline. What you need to know is your tax payment is due 9 months and 1 day after the end of your accounting period. So if you go into Companies House and search your company name, you'll see when your accounting period end is, and you can then add 9 months and 1 day to work out when you need to pay that tax. Now, your filing deadline comes a little bit later. You've got 12 months to actually file your corporation tax return. Same concept applies, and 12 months to your company accounting year end to get your filing deadline. Usually, you would file your accounts and then pay your tax at the 9-month mark. Now, larger companies where profits exceed £1.5 million are subject to slightly different rules in terms of when they pay. I'm not going to go into that in this video. When I talk about filing, I'm talking about a specific document. It's your CT600 corporation tax return. This is filed online through HMRC. You need to include your company accounts and your tax calculation along with it. It's also important to remember that HMRC requires you to keep your records, so receipts and invoices, to back up anything that's gone through your business for at least 6 years. If you miss your filing deadline, there's a penalty that starts at £100 and accrues over time and can also turn into a percentage of the tax that's due. And if you still don't file or pay, it can result in court proceedings. So that's everything you need to know about UK corporation tax, from who it applies